Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your rates rundown for April 10th, 2026. Let's start today by taking a look at our benchmarks. Since last Friday, U.S. Treasury yields are almost exactly unchanged at 4.32%, and mortgage rates are maybe just a shade lower, but still hovering right around 6.5. It's no secret that March was a tough month for mortgages, with rates up about a half a point. And while April hasn't brought much in terms of a return to the lows we saw in February, the stability we've seen over the past week and a half or so is a welcome development. Don't let the week over week change or lack of week over week change fool you. There actually has been a lot of movement in rates between these last two Fridays. Markets rallied hard, really across asset classes on Tuesday evening when news broke of a 2 week ceasefire in the Iran conflict. Mortgage prices touched very, very briefly their best levels in a couple of weeks. That improvement, however, was short lived as we'll call it differences of opinion between Iran and Israel on the inclusion of Lebanon in the tentative plan really prevented any significant reopening of the Strait of Hormuz. Without boat traffic flowing again, oil prices remain elevated right around $98 a barrel. It's better than the hundred and teens we saw at the end of March, but really a far cry from the mid 60s we enjoyed just before this conflict began 6 weeks ago. Now, negotiations regarding the ceasefire proposal begin in Pakistan today. But given the unsuccessful start so far, investors are very hesitant to make any new bets until real progress is made. And that means boats actually moving. And that's why markets have been trading largely sideways for the past couple of sessions. We also got a decent amount of economic data this week. Data continues to not be a major source of market movement, just given the dominance of geopolitical headlines. But with the Fed meeting less than 3 weeks away, it's important to keep an eye on it still. So, inflation measures, that's CPI and core PCE, both came in more or less in line with expectations, which is good. But they also remain elevated and show a spike in energy costs, which is bad. That's bad for inflation, of course, but I think the Fed is still of the mindset that this is a temporary shock and will continue to be looking past it for the purpose of policy setting. But the impact of the supply disruption on economic growth is potentially harder to look past. And that's particularly true, speaking of economic growth, when you look at GDP, which we also got this week, and it showed that the economy expanded at just 0.5% in Q4. That's a significant downturn from 4.4%, which we saw in Q3. So growth was clearly slowing even before oil hit triple digits. The extent to which the Fed continues to look at these factors as temporary versus sustained will, at least in part, hinge on how well these peace talks go. If they go well and the movement of ships resumes in short order, markets will rally back. I don't expect them to get back to the end of February levels, just given the fact that the bombings have left some long term impacts on oil production capacity, but rates should improve significantly. However, if they go poorly, it's tough to see where another chance at a diplomatic solution might emerge from in the near future. And the negative impact on inflation and especially on economic growth increase, and the Fed's ability to look past it decrease with every passing day. So buyer beware. That's all I got for you this week, folks. Have a great weekend, and we'll see you next time.